Anurag Singh, the managing partner from Ansett Capital, is joining us to talk to us about just that. Anurag, not great headlines this morning at all, and perhaps wasn't really factored by the street because it was expected that maybe there would be some sort of reconciliation or maybe very, very tempered moves. But this comes in as a bit of a shock, right?
Absolutely, absolutely, Anisha. So, I mean, this afternoon, Wall Street Journal reported that probably a compromise has been reached, and Israel has agreed to a kind of a very tepid response. But I guess one thing that Israel might have learned, and we are all not geopolitical experts, right? So I would leave it for those to define what this is. But I think they have taken the surprise element this time. So clearly this is not good, but I think in the near term, we'll have to wait for next 24 hours to see how it unfolds. But I would refrain commenting anything more on the geopolitics side of it. Markets is our forte. They're not looking good for now, but I think there is hope, and we can discuss about that as well, Anisha.
Yeah, sure, fair enough. It seems like as of now, the big trigger is, of course, the geopolitical concerns, which is why the Nifty implied open as well is indicating a downtick of nearly 386 points right now. But sure, there are also other worries and concerns, Anurag. Do you think when it comes to the rest of the globe, the other big worry continues to remain inflation, which is now reaccelerating?
Yeah, so that's I think let's look at this in two parts. One is look, we understand Federal Reserve officials clearly are on a defensive stance. They didn't like the last 3 months data, but nobody expected that to be a straight line fall to 2%. So I think that's given and understandable, and they have to maintain a cautious stance. But I think there are certain positive developments which I feel will support the markets. One is the earnings for this year, and we have seen bank earnings. They were good, in line with expectations. Netflix reported today pretty solid numbers. S&P this year might report $250 per share kind of earnings, which means that even if we are at 5,000, that's a 20 multiple, which I think, given the liquidity, it's a phenomenal level. And pretty much, I understand markets have a skew towards the big tech companies, but largely, I think the rest of the market is not very expensive. But I think ultimately these things might work on the positive side as well, right? If the oil goes up, strategic oil reserves might be called into action. Federal Reserve might be willing to let go, of the inflation mandate for the time being, in the interest of holding up the economy. By the way, the housing numbers came in today. They were at an all-time low. I think the numbers like 4 million home sales per year, those numbers have not been seen since 2008. So I think in combination, we can also see it in the manner that, Federal Reserve might be forced to take a little softer stance, and inflation might cool down a little faster, aside of the energy, which Federal Reserve anyways doesn't look at. Now, this is US markets. Avan, I would say Indian markets, and all emerging markets, they face a
Sure.
little bit of a danger more because, whenever oil spikes, dollar fight happens, interest rates, are higher, then money moves out of emerging markets. And I think
Right.
that's the only caution I would call for India.
Yeah, India in a danger mode and other EMs as well, in your words. But Ajay, do you concur with this view? Because time and again, when these geopolitical roadblocks have come into picture, whether Ukraine, Russia, or even others in the Western Asian side, India has managed to insulate itself to a large extent thanks to the solid, foreign affairs handling that our ministries have done. What do you think this time around should be the view when the market does tumble by 300, 400 points, as the GIFT Nifty is implying? Would they be buying at lower levels, Ajay?
Difficult to say. Right now, it's risk off, and only safe havens like Swiss franc, the dollar, the US bonds are getting bought, and everything else is getting sold. We are linked in because of the oil price, and if Iran decides to strike at the most vulnerable point, that's clearly the Straits of Hormuz, which if they, append shipping through that, that's 17 million barrels of oil a day that they can impact. Already the Red Sea is a no-go zone because of Iranian proxies. So the risk to India and other oil importers is the oil price. Otherwise, it's a regional conflict. It's not that major, but the risk is that Iran chooses to strike on, say, Saudi oil refineries or brings down oil shipping in the Persian Gulf. So India will stay equidistant. Israel is a friend of India. Iran is a friend of India. So as far as the foreign policy goes, don't expect any sides from India. And overall, our economy is not that impacted, but it's the oil, if this conflict increases. And clearly, Ukraine for the first time taught us after 75 years of war in the center of Europe how to price that risk. Now, this is going to teach us with two nuclear armed powers. And if a regional conflict like this starts with oil added on, we have not seen this since 1973. That an Israel action by the Arab nations happened. Now the Persians are at war with Israel. We have to see how that works out. I don't think there is anybody living who knows how to price this risk. So markets are also playing blind man's bluff, and they are just selling off first and then asking questions. Don't try to time this market. We don't know where more it will go and how more it will go. Both are very strong missile-based powers, and this could increase in scope very fast. So very difficult to price this.
So I know while it is difficult to price it at a time like this, given that you're talking about geopolitical risk taking center stage, is there that big worry of, a free fall or some sort of a big move on the downside? What should be the approach right now for investors, or any guidance?
One that's for me.
Yes, Ajay, for you. Yes.
Yeah. So, if there is a sell-off, like we have been seeing FIs selling off consistently over the last few days at the start of this. So, going into the end of the US market, closing of US markets last evening, it was the Fed speak that was dominant. And this morning, and we thought after the Passover festival, the Israelis will look at something. Hopefully by then, the world would have put pressure that don't destroy the sympathy wave that is there in your favor by taking a retaliatory action right now. Clearly, that doesn't seem to have worked. There is still a lot of ifs and buts of how large an attack was this, or was it limited to one missile base or Air Force base? Next to it are nuclear enrichment facilities in Natanz, and as well as Isfahan has a nuclear enrichment facility of Iran. So we really don't know right now. A market like Japan selling off 3% this morning, European futures all at 1.5 to 2% down, US futures sharply down. So clearly markets are selling first and then trying to analyze. This is not the time to pick up these falling knives. I think staying away is better today. Let this situation work out over the weekend. At least we get some clarity, some official news. Till now, we are struggling for any official comment. Now, news is coming out that Israel had let US know yesterday itself that 24 hours to 48 hours there would be a retaliatory strike. But these are all rumors that are coming out. There is no official version still that's being put on the table. So it might be an evolving situation. It might see a barrage of Israeli missiles hitting all the nuclear facilities. We really don't know. So how far this will go, it could go down 5% even by next week. So today, probably you see a 2 to 3% cut in the Indian markets in line with what's happening in the rest of Asia.
Try and catch the falling knives. It's best to stay away right now because it can quickly get escalated as well. That's the view coming in from Ajay Bagga. And yes, as he pointed out, Asia is in a slew of red, whether it's Kospi, which is down 3%, Nikkei, which is down 3.5%. And of course, the US futures have tumbled almost 500 points. So all of that putting pressure. Surprisingly, gold has also actually, not surprisingly, but actually in tandem with that risk of mode, the gold has actually spiked to the levels of 24, 23. So very close close to those record high levels, and other equity markets and other risk assets like Bitcoin, etc., have tumbled. But Anurag, a question to you: what's the best investment strategy right now in terms of a tactical trade? Then, is it best perhaps to be in safe haven asset classes like gold? Is that what the suggestion is, or maybe U.S. market as well, which has been doing quite well for itself despite all adversities? Would you buy this dip, whether in the U.S. market or Indian market?
So first is those who are already in the market, don't panic sell, right? At least tomorrow is the worst day to sell, right? Or for India, today is the worst time to sell if for the money which is already invested. For the rest of it, don't try and catch the falling knife, but at least not right now. In any case, Indian markets, you should not jump at these valuations. They're not mouth-watering at all, right? So I think just keep cash aside. Cash is king, and what is invested, don't panic sell. This will recover. I mean, we should not be projecting this, but we are optimistic, and market should recover much sooner from this one compared to the Ukraine war. I think at least because the back channel talks are pretty strong here, and I think this will not be that big of a worry. So overall, that's my advice, Anisha.
Okay, point taken. Anurag, Ajay, thanks so much for making time and speaking with us today.
If you like this video, then like, share and subscribe to ET Now.